Imagine you've just earned some extra cash, whether it be from a side gig, a gift, or savings. Instead of letting it sit in your wallet or bank account, you think, how can I make this grow? That's where stocks and bonds come in. But here's the thing, a lot of people find these terms intimidating. What are stocks and bonds? How do they work? And which one's right for you? Don't worry, we are Group 1 and we have got you covered. In this video, we'll break everything down, starting with formal definitions and real-life examples, and then move into practical tips and calculations, and also even some exercises to test your knowledge. Let's get started. A stock is a share in the ownership of a company. When you buy a stock, you become a shareholder, making you a partial owner of that company. Now, here is the simple explanation. Let's think of a whole pizza. Let's think of the whole pizza as the company. And when you buy a stock of that company, you get a share. And you can think of that share as the slice of this pizza right here. If the company grows, becomes more profitable, your slice becomes more valuable. Or if the company or the pizza grows, your share also grows. And if the opposite happens, if the company you invested in becomes smaller, your share or the slice will also become smaller. That is how stocks work. In order to fully understand the concept of stocks, it is important that we become familiar with these following terms. First, dividend, dividend per share, market value, and par value. Now, let us go over all four terms, but let's start with the first one, dividend. It is a portion of the company's profit shared with shareholders. Think of it like getting a paycheck from the company you partially own. When a company earns a profit, it can either reinvest that money into the business or share some of it with its shareholders as a dividend. Dividends are usually paid quarterly, but some companies pay them annually or even monthly. Let us say you own 100 shares of a company that declares a dividend of 5 pesos per share. You would receive a total of 100 times 5, 500 pesos. Not bad, right? However, not all companies pay dividends. For instance, tech companies like to reinvest their profits to fuel growth, while more established companies like those in utilities or telecommunications often pay steady dividends. Dividends are a great way for investors to earn passive income, but it is important to ask, can the company sustain its dividends? A company with inconsistent earnings might cut its dividends during tough times. On the other hand, companies with strong cash flow are more likely to maintain or even increase their dividends over time. On to the next term, dividend per share. It is how much dividend each share gets. This tells you how much each share earns from the total dividend payout. It is essentially the slice of the profit pie that goes to each shareholder. If a company's dividend per share is growing year after year, it is usually a good sign of financial health. So the formula of dividend per share is total dividend over number of outstanding shares. But more onto that later, as you're going to discuss each formula. But right now, we're going to focus on just the terms and its meaning. So, dividend per share can give you insight into how much value you're getting as a shareholder. But remember, higher dividend per share isn't always better if the company is stretching itself to pay dividends. It is worth checking the payout ratio, or the percentage of earnings paid out as dividends, to see if the company's dividend policy is sustainable. Let's go over the Next term, which is market value. It is the current price of the stock. Think of market value as the stock's price tag. It changes constantly based on supply and demand in the market. If investors are confident in a company's future, the demand for its stock increases, and so does its market value. So if the demand increases, the value also increases, or the market value. Conversely, if confidence drops, so does its price, or so does the market value. Let us say you bought shares of a company at 1,000 pesos each. Let's say 1,000 pesos. A few months later, good news about the company's new product drives up demand, and the market value of your shares rises to 1,500 pesos. So that's a capital gain of 500 pesos per share if you decide to sell. But the reverse can also happen. Bad news could push the market value below 1,000 pesos, resulting in a paper loss. Market value is dynamic because it reflects investors' perceptions of a company's performance, potential, and risk. It's influenced by factors like earnings, reports, economics conditions, industry trends, and even geopolitical events. A good investor keeps an eye on market value trends while also looking at other indicators like earnings and ratios to evaluate whether the stock is overpriced or a bargain. And last but not the least is par value. It is the nominal value stated in the stock certificate, which does not change. Par value is a company's way of assigning a baseline value to its shares or bonds. For stocks, par value is largely symbolic in today's markets. Most stocks trade far above or below their par value because market value is determined by investor demand. For bonds, however, par value is more significant, but let's talk about bonds later on. So, imagine a company issues shares with a par value of 10 pesos. Even if the shares are trading on the market at 1,000 pesos, so shares at the market at 1,000 pesos, the par value remains 10 pesos still. Similarly for bonds, if you buy a bond with a par value of 1,000 pesos, this is the amount you will receive at the end of the bond's term, regardless of whether the bond's market price changes. So, while par value for stocks doesn't hold much weight in modern investing, it can still play a role in legal and accounting matters. For bonds, par value is crucial because it forms the basis for calculating coupon payments and the bond yield. So, just a quick recap. Dividend, it is a portion of the company's profit shared with shareholders. So, portion of the company's profit. Dividend per share, how much dividend each share gets. Market value, current price of the stock. Par value, the nominal value stated in the stock certificate, which does not change. So, those are all. Now that we have discussed about stocks, let's go over bonds. So, what really is a bond? A bond is an interest-bearing security that represents a loan made by an investor to a company or government. The bond issuer promises to pay back the principal amount along with the regular interest over a set period. Okay, think of it like this. When you buy a bond, you're lending money to a company. So this is you, and this is the company. You're lending money to a company, let's say $1,000. And the issuer agrees to pay you back. So the 1,000 you gave, the company will give it to you back along with some interest depending on what you have agreed on, stated on the bond certificate. So bonds are like the reliable friend who always pays you back exactly as promised. Do we all have that friend? I don't think so. Kidding aside, let's discuss the few terms related to bond. Now, it is important that we go over the few terms related to bonds as well, just like we did with stocks. So, here are the 4 terms that are essential for you to better grasp the concept and the topic bonds. So, here are the terms. First term, coupon. Next term, coupon rate. third term, face value, and the last term, term. Yes. Okay, let's go over the first one first. Coupon. What does it mean? It is the regular interest payment bondholders receive. So let's say, think of the coupon as your bond's paycheck. It is the income you earn for lending your money. Coupons are usually paid annually or semi-annually and are fixed, so you know exactly how much you will receive every payment period. This predictability is what makes bonds so appealing to conservative investors. Okay, let's say you own a bond. Okay, let's draw a certificate. See, you own a bond with a face value of 1,000 pesos, and it has a 5% coupon rate. So, how much will you receive after the end of your term if the bond's term is 10 years? So, if it is 5%, what is 5% of 1,000? That is 50 pesos. So, that's for every year as your coupon payment. So, if the bond's term is 10 years, 50 times 10, you'll receive 50 pesos each year for 10 years, or a total of 500 pesos for the entire term. So, that's your income. On to the next term, coupon rate. It is the percentage of the bond's face value paid as interest. Okay, so I already said this in the previous example. So the coupon rate determines how much you will earn from the bond each year. It is calculated as a percentage of the face value. A higher coupon rate means higher income for the bondholder. But bonds with higher rates might come from issuers with more financial risk. So you should be aware of scams and safety. So imagine you buy two bonds with a face value of 1,000 pesos. Okay, so bond A and bond B. So both face value of 1,000 pesos. Bond A has a 4% coupon rate and bond B has a 6% coupon rate. So coupon rate of bond A is 4%, whereas bond B is 6%. So for bond A, you'll earn, what is the 4% of 1,000? You'll earn 40 pesos per year. For bond B, you will earn 60 pesos per year. So this shows how the coupon rate directly impacts your annual income. So as I have said, the higher the coupon rate, the higher your income will be. On to the next term, face value. It is the amount paid back at the end of the bond's term. So face value is like the principal in a loan. It is the base amount you lend to the bond issuer. This is what they will also return to you at the end of the bond's term. While the market price of the bond might fluctuate, it might go up and down, the face value remains fixed. So if you buy a bond with a face value of 1,000 pesos, you will get 1,000 pesos back as well, since it is fixed, regardless of whether the bond's market price went up or down while you were holding it. And last but not the least, term. It is the duration until the bond matures. Think of the term as a countdown. It starts the day you buy the bond, or called the purchase date, and ends when it matures. The maturity date is the start, year 0, and end, maturity date, year 3. Short-term bonds usually have terms of 1 up to 3 years, just like this timeline right here. The term is a total of 3 years. Medium-term bonds range from 3 to 10 years, and long-term bonds can go up to 30 years. Longer terms often come with higher coupon rates because your money is tied up for a longer period. So, say you buy a 5-year bond today. For the next 5 years, you'll receive regular coupon payments. On the 5th year, it's maturity date. You also get back the bond's face value. The term determines how long you will wait for your principal to be repaid. So let's look at an example here that wraps everything up. This is a bond certificate. So this certifies that Aljon Lozano is the rightful owner of 1 million pesos of ABC bonds bearing 5% interest. Is the interest or the coupon rate? And maturing on November 30, 2030. Issued on November 30, 2024 by ABC Bonds. Christian Mariu, Chief Financial Officer of ABC Bonds. So, let's break this down. Let's erase this for a bit. Okay, so let's create a timeline. So, this is 0, 1, 2, 3, 4, 5, and 6. So let's erase this. 3, 4, 5, and 6. Let's just put it like that, and then so let's look at the key terms first. So let's determine what is the face value, the coupon rate, and the term. So face value here is here 1 million pesos. So let's say 1 million pesos. The coupon rate here is coupon rate here, the percentage 5%, and for the term, so take note, issued on November 30, and it's also maturing on November 30, so it's the same month and same day, only the year is the differing factor. So this is issued on November 30, 2024 and matures on 2030. That's a total of 6 years. Basic math. So now the term, we have the term 6 years. So the 5% here refers to the annual coupon rate. So every year you receive 5% coupon rate. So what is 5% of 1 million? So just multiply that. 1 million times 0.05, that's equal to 50,000, if I'm not mistaken. 50,000. So every year you receive sort of like an income of 50,000. So another 50,000. This is for your first year. This is for your second year. 50,000, and that goes on and on until the end. Until the end of the term. So you get 650,000, which is a total of 300,000, plus your face value. So you get your face value back of 1 million plus 300,000, total of 1,300,000 in a span of 6 years. So Mr. Aljan Lozano is now a wealthy man. So that's all for bonds, and now let's really dive in and know the key differences of stocks and bonds. Stocks and bonds are very different, so let's break it down to further help you understand which one might suit you better. It just depends on your personality. So, stocks. When you buy a stock, you become a part owner of the company. You share in its profits or losses and can vote on company decisions. On the other hand, buying a bond makes you a lender to the company or government. You don't really own part of the business, but you will earn fixed interest over time. Stocks are higher risk investments because their value depends on the company's performance and market conditions. However, the potential returns can be much higher than bonds, so it's a high risk, high reward system. Whereas bonds are considered safer because they provide predictable returns through interest payments. Even if the company struggles, bondholders are paid before shareholders in case of bankruptcy. So which one's ideal for you? Stocks are ideal for long-term investors who are comfortable with the risk and want the chance to grow their money over time. So if you're more of an aggressive person, then stocks might be ideal for you. Bonds, however, are great for conservative investors seeking steady income or preserving their wealth without much risk. So if you just want to play it safe, then bonds might be a greater option for you. Think of stocks as the thrill of a roller coaster ride, where you might win but face some stomach-dropping moments. Bonds, on the other hand, are like a smooth, steady drive, less exciting but predictable and reliable. So, would you rather enjoy the thrills of stocks or stick with the steady pace of bonds? Let us know in the comments down below. At this moment, it is now time to discuss about metrics for stocks and bonds. So now is the time for numbers, calculations, and applications. So let's start with stocks. So let's go over the first one. Dividend per share. This is not unfamiliar as I've already discussed this earlier on. So the formula goes as follows. So DPS is equal to total dividend over number of outstanding shares. So let's go over a quick example. Right, so if a company declares a total dividend of 20 million pesos and has 4 million outstanding shares, how much is the dividend per share? So the formula is DPS is equal to total dividend, which is 20 million divided by the outstanding shares, which is 4 million. So let's just cancel out the zeros, cancel. So 20 divided by 4 is equal to 5 pesos per share. So this is your final answer for the dividend per share. Simple. Next one, dividend yield ratio. So for the formula for dividend yield ratio is dividend yield is equal to dividend per share divided by market value. So an example for that is this one. A stock with a market value of 500 pesos and a dividend per share or DPS of 25 pesos has a dividend yield of what? So using the formula here, let's determine first the terms, the givens. So a stock with a market value of 500 pesos. So this is the market value and the dividend per share is 25 pesos. So dividend yield ratio is equal to dividend per share of 25 divided by market value of 500, and that will equal to 5%. So your dividend yield ratio is 5%. This means you earn 5% annually in dividends based on the stock's current price. Next one, price to earnings ratio. So the formula for price to earnings ratio goes as follows. So price to earnings ratio is equal to market price per share divided by earnings per share or EPS. So quick example is a stock priced at 1,000 pesos with an EPS or earnings per share of 50 pesos has a price to earnings ratio of, let's determine the givens, price at 1,000 pesos. So this is the market price per share with an EPS of 50 pesos has a price to earnings ratio of, so market price per share, which is 1,000 divided by earnings per share of 50. So your price to earnings ratio is 20. So this means you're paying 20 pesos for every peso of the company's earnings. So high price to earnings ratio often indicate growth stocks, while lower ratios suggest value stocks. So that's it, and let's go over the number 4, earnings per share. Formula is earnings per share is equal to net income of preferred dividends divided by number of outstanding shares. So we have an example over here. A company with a net income of 10 million pesos and 1 million shares has an earnings per share of, so this is our net income as this here, so of 1 million shares. So the number of outstanding shares is 1 million. So our earnings per share is 10 million, which is the net income, over 1 million outstanding shares. So 10 million divided by 1 million is equal to 10 pesos per share. This means each share generates 10 pesos in earnings. So we have the last one over here, and it's called stock yield ratio. So our formula for stock yield ratio is dividend per share divided by market value. And you also multiply it times 100 because it's percentage. We're talking about percentage here. So if a stock's market value is 800 pesos and its dividend per share is 40 pesos, what is its stock yield ratio? Okay, so the dividend per share is 40 pesos, so 40 divided by the market value of 800. So also, don't forget, that's around 0.05, and you multiply it by 100, so that will equal to 5%. This means the stock offers a 5% return based on dividends alone. So times 100, also the other one, times 100. There we go. Now let's talk about bonds. So these bond metrics are key to understanding your bond's income and value. So the first one we have here is coupon payment. So the formula for coupon payment is face value times coupon rate. Say for example, what is the coupon payment for a bond with a face value of 1 million pesos and a coupon rate of 5%? What is our face value here? In this specific example, our face value is 1 million and our coupon rate is 5%. So 5% can be converted to decimal. Just move 2 decimal places to the left, so 0.05. So this is going to be what is used for the formula. Excuse me. So 1 million times 0.05 is equal to your coupon payment. So the value for this is 50,000 pesos annually. This is your final answer right here. Next one, yield to maturity. So actually the yield to maturity is calculated using a complex formula that accounts for the bond's face value, market price, coupon payments, and term. So for simplicity, yield to maturity is approximately coupon payment plus face value minus market price divided by years to maturity all over face value plus market price over 2 times 100. So for example, if a bond has a face value of 1 million pesos, market price of 950,000, coupon payment of 50,000 pesos, and a term of 5 years, so then the yield to maturity will go as follow. So yield to maturity is 50,000 plus 1 million minus 950,000 over 5 divided by 1 million plus 950,000 divided by 2, and you multiply everything by 100. So if you input this in your calculator, I think you really need a calculator for this, because especially when we're talking about big numbers. I mean, you can do this manually, but it would be easier to do in a calculator. But the answer for this is 6.15%. So this means the bond earns an effective annual return of about 6.15%. The last bond metric we're going to discuss in this video is current yield. So this one's a bit simpler compared to the last one. So the formula is current yield is equal to coupon payment divided by market payment times 100. So for example, what is the current yield for a bond with a coupon payment of 50,000 pesos and a market price of 950,000 pesos? So with our formula, coupon payment our coupon payment in the given example is 50,000 pesos, and our market payment in the given example is 950,000 pesos. So basic math, 50,000 divided by 950,000 times 100, we get 5.26%. This shows the bond's return based on its current price. So just a wrap up: coupon payment, yield to maturity, and current yield. These metrics are like the foundation for evaluating stocks and bonds. Once you understand how to calculate and interpret them, you'll have a much clearer picture of which investments suit your goals. We have covered the basics of stocks and bonds, their metrics, and even some drills to help you understand them better. But here's the thing: what's the use of learning everything if you don't know how to put it into place? That's why in this part, it is all about trading tips and strategies. So we will show you how to apply what you have learned to make smarter investment decisions, reduce risk, and maximize your returns. So let's dive into the practical side of trading. So I've got the first advice for you: diversify your portfolio. So imagine you invest all your money in tech stocks and the tech sector crashes. Without diversification, your entire portfolio takes a hit. But if you also own bonds or stocks in other industries like healthcare or energy, their stability might offset the losses. So if you have, let's say, 1 million pesos, you want to allocate 60% to stocks and 40% to bonds, and you want to diversify. So for example, in stocks, you invest in, this one is for tech, this one's for healthcare, and this one's for energy. This is to ensure stability. So that's for the first step. Next step, use stop loss and take profit orders. So a stop loss order automatically sells your stock if the price drops below a set level, limiting your losses. A take profit order does the opposite. It sells your stock when it reaches the target price, locking in your gains. Without these orders, you might hesitate to sell when prices drop, hoping they will recover, or even sell too early when prices rise, missing out on potential gains. So these tools help you stay disciplined and avoid emotional decisions. For example, if you buy stock worth 1,000 pesos, you might set a stop loss at 900 pesos, and you might want to cap your losses at 10%, and you could also set a take profit of at 1,300. So to secure a 30% return. So this means if the market value reaches 900 pesos, it will automatically sell to, so in order for your loss to be not that extreme, and if it reaches 1,300 pesos, if it rises to 1,300 pesos, it will also automatically sell. This is smart trading. So next step I have for you is follow simple moving averages. A simple moving average smooths out stock price trends by calculating the average price over a specific period, like 50 or 200 days. It's a great tool for spotting trends and identifying potential buy or sell signals. It helps you filter out short-term price fluctuations and focus on long-term trends. This is especially useful for identifying when a stock is overbought or oversold. So in order to use it, use the 50-day SMA for short-term trends and the 200-day SMA or simple moving average for long-term trends. Look for buy signals when the stock price crosses above the SMA and sell signals when it falls below. So, fourth tip, track market indices. So market indices like the PSE Composite Index track the performance of a group of stocks to reflect the overall market trend. Monitoring indices help you gauge market sentiment and compare your portfolio's performance. So by tracking it, you can identify whether the market is in a rising or falling phase and adjust your strategy accordingly. For example, if the PSE index is up 10% but your portfolio is only up 5%, you might explore sectors in the index that are outperforming. So, my next advice for you is bond laddering. What is bond laddering? It involves buying bonds with maturity dates to ensure regular cash flow and reduce interest rate risk. So, with a bond ladder, you're not locked into one interest rate for long periods. As bonds mature, you can reinvest at current rates, which is especially useful when rates are rising. So, how do you apply it? Buy bonds maturing in 1, 3, and 5 years. So, as each bond matures, reinvest the principal into a new 5-year bond to maintain the ladder. So, it's like a ladder. If this one matures, you invest it into another bond. So, my sixth step for you is start small and learn gradually. You always start small in life. So, begin with a small investment to familiarize yourself with the market before committing larger sums. So, starting small minimizes the risk of costly mistakes and gives you room to learn. As you gain confidence and knowledge, you can expand your portfolio. So, you can begin with 1 or 2 stocks or bonds, investing as little as, let's say, 5,000 pesos. Track their performance and test different strategies to see what works best. If you're new to investing, start with 5,000 pesos in a high dividend stock and 5,000 pesos in a bond. Track your returns and analyze what drives their performance. And number 7, understand risk and reward. Every investment involves risk. Understanding the trade-off between risk and reward helps you set realistic expectations and make informed choices. High-risk investments like growth stocks can offer big rewards but also steep losses. On the other hand, low-risk options like bonds provide stability but lower returns. So, for example, if you're saving for retirement in 30 years, you might invest in growth stocks. If you need cash in 2 years, stick with bonds or high dividend stocks. And last but potentially the most important tip I have for you guys is keep emotions in check. Do not let fear or greed dictate your investment decisions. Stick to your strategy. So, emotional decisions often lead to buying at market highs when prices are inflated or selling at lows out of panic, which can hurt long-term returns. So you must set clear goals and stick to your investment plan. Revisit your portfolio, but avoid reacting to short-term market noise. For example, if your stock drops 10% in 1 week, review the company's fundamentals instead of panicking. It might be a temporary dip rather than a sign of trouble. So remember, investing can seem complicated, but these tips can make it manageable. Stay disciplined, keep learning, and always remember this one. Investing is a marathon, not a sprint. Great job today! We are Group 1 and we hope you now have a solid understanding of stocks and bonds. Remember, investing is a journey. Keep learning and eventually you'll make good decisions over time. If you enjoyed this video, give us a like, subscribe, and drop your questions in the comments down below. Until next time, happy investing!